Hey everyone, and welcome to The Explainer. Today, we're unpacking the multi-billion-dollar world of financial risk. We're going to explore why humans are historically just so terrible at managing it, how machine learning is literally changing the game, and then exactly how you can pull your very own market data using Python. Let's jump right in. Okay, let's dive into this. When we talk about financial risk, I know it can sound kind of like an abstract concept, but the stakes are brutally real. The 2007 to 2008 global financial crisis, that wasn't just some streak of bad luck. It has literally been characterized as a colossal failure of risk management. The models that everyone completely trusted just broke down when they were put to the ultimate test. So here is our roadmap for today. Number 1, high stakes of financial risk. 2, decoding types of risk. 3, human flaws in finance. 4, the machine learning shift. And finally, number 5, fetching your financial data. Section 1, high stakes of financial risk. It's absolutely crucial to understand that it isn't just amateur traders getting wiped out here. Even the absolute smartest money on Wall Street gets it disastrously wrong sometimes. Just look at these massive historical catastrophes. Long-term capital management, or LTCM. This was a hedge fund managed by top-tier academics and practitioners. By 1998, they controlled over $100 billion, but they completely mismeasured their risk. After the Russian debt default, a massive flight to quality severely damaged their portfolio, and they went bust. And we saw similar billions of dollars blow-ups with Metal Gesellschaft in the gas and oil markets and Amaranth Advisors in natural gas futures. These weren't small calculation errors, They were fundamental failures to appropriately measure and account for risk. Moving on to Section 2, decoding types of risk. To actually manage risk, we first have to clearly define what shapes it takes. And this brilliantly illustrates the core concept at the heart of modern finance, Harry Markowitz's fundamental trade-off. Basically, risk and return go hand in hand. You don't necessarily want to eliminate all risk, right? Because then, you eliminate all return. The goal here is optimizing that exposure. Institutions basically have to juggle multiple threat vectors simultaneously. You've got market risk from things like shifting interest and exchange rates, credit risk from counterparty defaults, liquidity risk, which is basically the speed of cash and what happens when assets can't be offloaded quickly, and operational risk stemming from fraud or internal procedure failures. Monitoring this entire web of variables is exactly where traditional systems tend to really struggle. Section 3, human flaws in finance. Look, if finance were purely a math problem, we would have solved it by now, right? But the reality is, perfectly rational decision makers just do not exist. One of the absolute biggest psychological hurdles is asymmetric information. Think about adverse selection. This was famously coined by George Akerlof as the market for lemons. It happens when sellers are just much better informed than buyers. A perfect historical example of this was the opaque pre-crisis mortgage market. The originators of those bad mortgage loans knew way more about the terrible risks involved than the investors who were just happily buying them up as packaged securities. Now, what's really interesting here is how we can model adverse selection so clearly in the insurance industry. Adding more people to a contract actually diminishes the risk profile alongside the average cost. Basically, pooling demographics fundamentally alters those risk dynamics. Another major human flaw? Moral hazard. This is a highly dangerous situation where one party takes on excessive risk simply because they know someone else is going to bear the burden if things go sideways. A prime historical example that many point to is the Federal Reserve's bailout of that massive hedge fund we talked about earlier, LTCM. When institutions believe they are quote-unquote too big to fail and that they'll be rescued, their appetite for reckless risk completely skyrockets. Section 4, the machine learning shift. So, we've got high stakes, complex risks, and heavily flawed human psychology. To fix this, we're abandoning the rigid theories of the past for modern, data-centric solutions. For decades, empirical research in finance relied super heavily on traditional statistical inference, or econometrics. Now, these traditional parametric models are useful, sure, but they suffer from low variance and high bias. They're incredibly rigid, and they assume a very specific structure for the data. Machine learning, on the other hand, doesn't assume it knows the underlying data-generating process. It is highly flexible, entirely data-centric, and intensely focused on predictive power. As financial data distributions constantly change, machine learning models can actually adapt themselves to those new patterns. It is literally a total game changer for risk management. Section 5, fetching your financial data. Okay, Enough theory. Let's look at the practical, micro-level application of grabbing market data so you can actually start coding. If you're just getting started, I promise you, you don't need a Bloomberg terminal that costs as much as a car. You literally just need Python and an API called yfinance. Think of yfinance as your gateway drug to the world of financial data. It's completely free, it's incredibly easy to use, and for basic financial analysis, it provides an amazing foundation to build upon. Using yfinance yields your standard OHLCV data. That's open, high, low, close, and volume, like we see with NVIDIA stock here. Getting this clean, session-level data mapped directly to a pandas data frame is the foundational raw material for basically any predictive model. The Python workflow itself is beautifully simple. First, import your packages like pandas and yfinance. Second, define your historical time window. Third, call the API to download single or multiple tickers. And finally, plot those closing prices using Matplotlib. You can literally go from zero to visualizing real market data in under 10 lines of code. Let's see how this builds as your models get a bit more complex. Say you're analyzing Apple, Meta, and NVIDIA simultaneously. Well, yfinance returns a multi-index data frame. This allows for a hierarchical organization, top-level ticker symbols over OHLCV price types. It keeps massive datasets perfectly structured for algorithmic ingesting.
Now, once you outgrow the free yfinance tier and you're ready to start building serious algorithms, there are several premium APIs you can explore. Polygon.io offers incredible institutional-grade reliability. Financial Modeling Prep API goes beyond just prices and gives you deep company fundamentals. And the EOD Historical Data API gives you massive global coverage across dozens of international exchanges.
And that brings us to the ultimate question. We've explored the massive risks in the financial system, we've seen how human bias creates dangerous blind spots, and we've learned how to leverage Python to instantly pull historical market data. The tools are literally right there at your fingertips. So now that you have this OHLCV data, what will your machine learning model predict? The market is waiting for you to find out. Thanks for joining me on this explainer, and keep exploring.